Imagine the absolute greatest corporate heist in modern financial history, and it is playing out right before our eyes. We're not talking about masked robbers breaking into a bank vault in the dead of night. No, this is a methodical, multi-trillion-dollar takeover of an entire financial ecosystem. For years now, the story of cryptocurrency has been this classic tale of rebellion, right? The underdog tech startups setting out to totally replace traditional, slow-moving banks. But right now, a massive structural shift is actually taking place. Traditional finance isn't just fighting back anymore, they are orchestrating a sweeping capture of the exact market that was built to replace them. In our explainer today, we're breaking down this stunning reality using some fantastic analysis from Dr. Dana Love. We're going to map out exactly how Wall Street is effectively boxing out the biggest crypto exchanges on the planet.
Okay, let's dive straight into the hard data. According to Dr. Dana Love's analysis, we are currently witnessing a complete and total collapse in Coinbase's consumer transaction revenue. We're talking a drop from $1.1 billion in the first quarter of 2025 all the way down to $567 million in the first quarter of 2026. That is a staggering 48% year-over-year evaporation of their retail revenue. I mean, in literally any industry, losing nearly half of your consumer transaction revenue in just a 12-month window is an absolute five-alarm fire. But what makes this so incredibly important isn't just the sheer monetary loss, it's the context in which this loss is actually happening.
Usually, when a crypto exchange starts bleeding revenue like this, it's just because the entire crypto market is crashing. We call that a cyclical downturn. But consider this contrast for a second. This revenue collapse is happening while Bitcoin prices are actually up. This completely defies historical logic. So, the absolutely crucial point here is this. What we are seeing right now is not a market cycle issue. It is a structural exit. Retail investors aren't just losing interest in crypto and packing up their bags. No. They are specifically packing up their bags and leaving Coinbase. The money is still flowing, but it is literally bypassing the very exchange that was originally built to handle it.
Number 1. The Uno Reverso. Capturing the market. So to understand where all that money is actually going, we have to look at the strategy traditional banks are executing. Because what they're doing is they're taking the exact tools, the technology, and even the language that crypto pioneered, and they are weaponizing them to capture the market for themselves. They are cutting out the very companies that set out to cut them out.
Jed Finn, who is the head of wealth management over at Morgan Stanley, really describes their specific strategy perfectly here. He literally calls it eliminating the middlemen that were originally built to eliminate banks. It is wonderfully ironic, isn't it? I mean, the entire original ethos of cryptocurrency was to remove Wall Street completely from the equation. Coinbase and others positioned themselves as these revolutionary new intermediaries. But now, by offering Bitcoin ETFs and seamless, direct trading right inside existing platforms like E-Trade, Wall Street is making separate, dedicated crypto exchange accounts entirely unnecessary. Think about it. Why would you go through the hassle of opening a specialized crypto account when your traditional broker now offers it right next to your 401k?
Number 2. Phase 6 Capture. The playbook. Dr. Dana Love has this brilliant framework for understanding exactly how these massive incumbent institutions operate when they're faced with a highly disruptive democratizing technology. Because, it doesn't happen overnight. It actually follows a very specific historical playbook. He outlines a 6-phase pattern of institutional capture. And honestly, this brilliantly illustrates the long game that Wall Street has been playing while the crypto startups actually thought they were winning.
So this institutional takeover follows a pretty clear chronological pattern. Step 1, which covers phases 1 through 5, was defined for years by simple ridicule and observation. You probably remember the headlines. Titans of traditional finance at institutions like Morgan Stanley and JP Morgan were publicly laughing at Bitcoin. They were calling it a fraud, a Ponzi scheme, or famously a pet rock. But here's the thing. While they were laughing publicly, they were observing privately. They were sitting back, waiting for the technology to mature, waiting for all those early bugs to be worked out, and crucially, waiting for the regulations to clear. They just let the startups take all the early legal and financial hits. And then comes step 2, phase 6, the capture. Once those regulatory moats dry up and the path is totally clear, the giants finally step in.
Which brings us perfectly to the concept of the toll road. This is exactly what phase 6 looks like in practice. Wall Street is entering a market that is now fundamentally mature. They didn't have to spend a decade fighting the SEC in court to establish the rules of the road. They didn't have to spend billions educating the general public on what a blockchain even is. Companies like Coinbase did all of that heavy lifting for them. Now, the traditional institutions are simply swooping in to act as the toll operators on the financial highways that the crypto pioneers already constructed. They just monetize the infrastructure someone else built. It is a brutal, but let's be honest, highly effective corporate strategy.
Number 3. Structural advantage. Incumbent scale. When Wall Street finally decides to make its move, the battle isn't even close to a fair fight. The startups that build the crypto industry from the ground up are suddenly going head-to-head with behemoths that possess Goliath-sized firepower. We are talking about literal centuries of entrenched financial dominance, massive pools of capital, and an unparalleled distribution network that crypto exchanges simply cannot ever hope to match.
Just take a second to really absorb the staggering scale of this structural advantage. Morgan Stanley alone commands $9.3 trillion in managed assets. Trillion with a T. They have an absolute army of 16,000 financial advisors actively talking to clients every single day, guiding their investment choices. And when they finally decided to roll out crypto trading, they didn't have to spend billions of dollars on marketing to acquire those users one by one. No, they simply flipped a switch and rolled it out to 8.6 million existing E-Trade customers. To put that into perspective for you, unlocking crypto for those 8.6 million E-Trade users nearly matches Coinbase's entire active monthly user base, all in one single effortless stroke. The scale of distribution here is just overwhelming.
But scale is really only half the equation here. The other half is psychology. Wealthy clients, retirees, and seasoned professionals hold the vast majority of investment capital out there, and for them, fiduciary trust trumps risky exchanges every single time. These investors absolutely want lower fees, sure, but more importantly, they want the safety, the integration, and the security of their existing trusted brokerage accounts. If a high-net-worth individual wants exposure to Bitcoin, they are far more comfortable calling up their Morgan Stanley advisor to execute the trade safely rather than trying to navigate the risks of opening a brand new, standalone account on a crypto-native exchange. The traditional banks already own the trust.
Number 4, proof of concept, the future. Now, okay, this doesn't mean a massive company like Coinbase is just going to vanish into thin air tomorrow. As Dr. Love points out, they definitely have other revenue streams. They're building out their own Layer 2 blockchain network called Base, and they're heavily diversifying their business. But we absolutely cannot ignore the fundamental reality presented by the data today. Their core, bread-and-butter retail business, the very engine that actually drove their massive valuation in the first place, is being permanently drained away by Wall Street brokerage firms offering a more integrated, trusted, and often significantly cheaper product.
Which leads us to the ultimate, true paradigm-shifting realization of this entire explainer. When the history books are eventually written about the first major era of cryptocurrency, the final conclusion might just be this. Coinbase wasn't actually Wall Street's competition. It was literally their proof of concept. The crypto-native exchanges essentially spent a decade running the world's most expensive beta test. They proved beyond a shadow of a doubt that there was massive consumer demand for digital assets. They fought all the agonizing regulatory battles to legitimize the asset class, and they built the initial on-ramps. And once the concept was fully proven, well, the traditional financial incumbents simply absorbed it.
We are currently witnessing a monumental transfer of control, and it really leaves us with a deeply profound question. The entire genesis block of cryptocurrency, the very reason Bitcoin was created in the first place, was to forge a decentralized alternative to Wall Street. But if Wall Street successfully captures this market entirely, if they become the primary custodians, the ETF managers, and the toll operators of the entire crypto infrastructure, is it actually still decentralized, or did the traditional financial system simply digest the revolution? Definitely something to think about as you watch these markets evolve.